it's time to focus in on fixed income, specifically what's happening in the bond markets, not just here in India, but globally. Lakshmi Iyer, the President and Chief Investment Officer at Kotak mutual fund, is joining in. Thank you so much, Lakshmi, for taking the time, and good evening to you. I want to start by asking about the context. As somebody that looks at this very, very closely on a daily basis, help us understand all of the factors that you're looking at, because there are so many moving parts. You're talking about what the Fed is doing, what the ECB is doing, what is happening in terms of growth, not just here in India, but globally. What all are you focusing on?
Yeah, hi, good evening. So currently, there is no doubt that as a bond manager, there is clearly a multiple ball juggling act that one is doing. And to superimpose, you anyways try to bake the cake, but here there is a cherry or the icing on the cake in the form of this geopolitical uncertainty as well, which is not really showing any signs of abating. But aside of that, I think globally, the one thing which is clearly daunting in terms of an uphill task is, and this is true for every central banker across the globe, is how to really tame inflation. And this monster inflation, of course, it's been present in various avatars across the economy, but this specific case is predominantly, the pandemic-led fallout of, a massive supply chain bottleneck. So it's not that people like you, me, and the rest of the viewers are actually chasing a lot of goods across the world, and that has led to a demand side, push in inflation. But it's largely cost-related factors or supply side, as we call. So I think that seems to be the biggest task. And of course, as I mentioned, the geopolitical crisis, the war between Russia and Ukraine still shows no signs of abating. So because of that, spike in commodity prices, specifically crude oil prices. And why crude oil is important for a country like India, because bulk of our requirements are actually imported. So I think it's a combination of rising inflation, which is consumer inflation. Equally important is to see the rising producer inflation. Rates are going up across the globe. The liquidity, the total banking system liquidity is reducing. I think it's a combination of all of these factors right now, which are clearly plaguing the minds of the bond investor.
I want to specifically talk about the US, though, for a bit. You've seen the Fed that has moved very aggressively against inflation, and that is expected to continue to take place in the coming months. Now, our central bank reacted very quickly after that initial action by the Fed. So what I'm trying to get at is, by hook or crook, do global central banks have to follow, in a sense, what the largest central bank does in some form or the other? Or can you say that a central bank in an emerging market, in a market like India, can remain isolated or uninhibited in that sense?
Honestly, to this question, there is no cookie cutter solution, and which is exactly is the biggest dilemma that a central banker in an emerging market, or specifically in a country like India, is facing. What is the US problem? Let's try to understand that first. You are at a 4-decade high plus of inflation in the US. The consumer index there, or the inflation there, is north of 8.5%. And the 10-year benchmark bond yield out there is just about 3%. So just imagine if you are a US investor, you're earning 3.1% on your 10-year bond, and inflation is taking away 8.5%, and you're left with a net of sub 5%. So that is where your real rate has gotten into significant negative territory. Now flip that to a situation in India. If you take the similar 10-year benchmark, of course, if you take the lower rates, the gap would be wider. True for India, true for the US as well. But look at India. Your inflation is roughly, the last number was close to about 7.1, and the 10-year benchmark is at about 7.5. So your real rates is flattish. I mean, it's marginally positive. But if you look at the previous inflation number, that's negative. So if you look at the quantum gap between the US negative real rates and India. The gap means that the US probably needs to act like literally fast and furious, if that were to be the disposition right now. Whereas India, or for that matter any other EM, may also need to act, because if they do not, then it could portend some impact or a negative impact on the respective currencies. So yes, act we should. The trajectory, or in terms of the pace, I think that can be debatable. Can India afford to move in probably a tad slower, and in terms of magnitude lower than the US? I would say if that's quite possible. But not hiking rates may not be a solution, given that inflation is a global problem and not just restricted to the US.
So here's another aspect to that then. So because I asked that question so that I could ask this next question. It's a follow-up to that, in a sense, because you've talked about the fact that India, if not in lockstep, it must walk alongside the US Fed, in a sense, right? Now, assuming that the fear of a recession in the US actually pans out, and that we do see a sizable deceleration in the US economy, the US Fed will then be forced to take steps to support growth. One would assume that the rates which will go up from this point will then start tapering off. One would assume that that would be the policy action. What happens then for emerging markets like India?
So clearly, that remains to be a live risk. There is no doubt about it. But if you look at some data points, and usually the bond curve, as we call it, the yield curve, tends to give you cues whether or not an economy is going into a recession. Typically we have seen, if more than 50% of the time, that in terms of the yield curve, like a 2 year being over the 10 year, or the 1 year being over the 10 year, if more than 50% of these data points are inverted, which means the short end is longer, higher in terms of yield than the longer end, that is a typical harbinger of recession. Where are we right now in the US? That number is close to about 30%. So that tells you that there is still some time to go before you pronounce it a recession. Now, assuming that happens, that could be obviously with a lag. Till then, what is the US Fed going to do? Clearly, they are going to be on the path of hiking rates. And that statement, I think there was some statement to that effect made yesterday also. So I think that's going to be very, very critical. And you look at the dollar index, it is moving pillar to pillar in terms of strength. And clearly, that may not really spell great news for EMs, or emerging market currencies. So yes, US, trying to backtrack some of its rate hikes is a live issue right now. But is that going to stop the FOMC from hiking rates? Well, we seriously have our doubts. So EM central bankers, including India, will have to act. And I would maintain that their stance of pace of rate hikes could be more cordial, could be more moderated compared to the US, but hike they must.
Now, I want to come to the nitty-gritties of how you're seeing the yield curve here in India. It has progressed very dramatically over the past few months as we've seen this change in monetary policy stance and in the increase in policy rates, the actions on liquidity, all of these aspects moving together, right, Lakshmi? So how has this moved in terms of your expectations of how the yield curve would progress? Has it been along the lines of your expectations, or has it moved differently? And how do you see it progressing? I think some commentators were pointing out that in all probability the RBI Monetary Policy Committee is front-loading rate action, and therefore you may not see a significant amount of rate action in the remainder of the financial year. So give us a sense of what could potentially happen.
Sure. So has the yield curve largely moved in line with expectations? Well, I would say yes. Two reasons for that. Typically, if you see in a normal, when things are okay in an economy, the nature of the curve is upward sloping. Upward sloping means something like this. Shorter end of the yield is lower yielding, offers a lower rate, and obviously as you progress higher and higher with an incremental risk that you are taking, the ask rates start going up. Now, what has happened is, in case of India, of course, true for the rest of the, as I said, the US yield curve is inverted in certain pockets. In India, we have seen CRR hikes. So that has added another element of liquidity withdrawal from the banking system. And this comes alongside rate hikes. And we have seen two back to back rate hikes. And as you rightly observed, the expectation of the market has been that there is going to be front loading of these rate hikes. So, in anticipation of this and what has actually occurred in the past, this upward sloping yield curve, while it remains upward sloping, has become a little bit flattish. And by flattish, I mean the shorter end or the middle end, specifically of the yield curve, has moved up faster. To give you a case in point, a 4 year, a 2026 maturity bond, or a 2027 maturity bond, which is a 5 year bond, in terms of yield, has seen a faster movement upward compared to a 10 year or a 15 year bond. Now, that effectively means that on a risk reward basis, incrementally, the middle end of the segment looks very attractive. And that's pretty much panned out in line with what we expected. And going forward, I concur with the view which the broad market is thinking. While we do maintain that rate hikes will continue from here till maybe financial year end, we are not as pessimistic as what the bond swap curve. We track the like the way US tracks the Fed fund futures curve, we as bond market participant track the OIS or the interest rate swap curve. Now, the interest rate swap curve is way, way more bearish. We are not as bearish in terms of outlook, given that quite a bit of front loading is already in the bond yields.
Uh, Very well summarized, I would think. What aspect, according to you, will the government's own borrowing calendar play, or what role will that development play in the development of the yield curve? Because that is one of the factors, Lakshmi, obviously, that has pushed yields higher even before the Reserve Bank of India came in and increased policy rates. You already saw an increase in the 10 year, and it moved very, very quickly higher, even when that announcement of the government's borrowing calendar came in, right? So, how are bond market participants looking at the government's borrowing calendar?
Borrowing calendar, is already known at the start of the year. It is a mammoth number. The total or the gross borrowing for the year FY 2023 is approximately 14 lakh crores or 14 trillion rupees. Now, that by no means is a small amount. Of course, there are maturities in the system, and therefore the net borrowing goes down. But I think markets focus on the week-on-week supply. Now, the week-on-week supply basis, this number is approximately around the ballpark region of 35,000 crores, or close to about $4 billion. Now, imagine week on week this kind of supply and very limited appetite from various stakeholders, which is banks, mutual funds, insurance companies, and FPIs, which is foreign portfolio investors. Now, foreign portfolio investors have been consistently net sellers in the Indian bond markets. Of course, the silver lining is that they've sold lesser in fixed income and more in equities, but that still doesn't make the number positive. Secondly, mutual funds have not been really getting monies in the long maturity funds or in gilt funds or bond funds. So they predominantly are patronizing the short end of the curve. And lastly, the banks, they already are quite full up as far as their government securities allocation is concerned. They're also trying to do a little bit more on the lending side to better the credit offtake. So just imagine in this, balancing scale, the supply seems to be outweighing the demand. Now, in this scenario, therefore, it is inevitable that yields start inching up, which is what we have seen. Going forward, I think the key thing is going to be how much more could be the elbow room for a fiscal slippage. Now, if that fiscal slippage, well, I would assign right now maybe a low chance of a massive slippage in the fiscal deficit. But assuming that happens, and bulk of that fiscal slippage is going to be funded by government or by market borrowing, that again could act as double whammy. Right now, those considerations are somewhere in the periphery of the bond markets. It's not really attained center stage, but going into maybe October, November, I think this will start resurfacing. So clearly, we are looking at a range-bound movement on the 10-year benchmark. Uh, and apart from this, of course, the global factors keep creating, oscillating movements of headwinds and tailwinds. So determining factor, fiscal deficit, clearly important. How well it will be managed is equally important for the incremental direction of bond yields going forward.
My last question, Lakshmi, relates to strategy for the retail investor. And understandably, people are little, well, they don't necessarily pay as much attention to their fixed income portfolio as they should, I think. In my opinion, they pay more attention to equity. Having said that, what should the strategy be? Should they stay on the low end of the spectrum, continue to stay despite the kind of increase that you've seen in yields, and wait a little bit more for the dust to settle before they get onto the long side?
See, fixed income, you're absolutely bang on, has typically been the Cinderella, in a financial portfolio. Having said that, I think the yields have risen quite drastically. I would say north of 1.5% plus jump in bond yields in the last maybe 2 quarters plus, which is about 8 odd months plus. That creates an opportunity for the investor today to create a sound fixed income portfolio. Now, what could be a potential, sound portfolio category to hold today? Uh, Given that we have seen a massive jump in the yields, especially at the mid end, uh, owning or creating a portfolio of fixed income centered around 3 to 3.5 or maybe 4 years, that kind of a duration bucket could be a great strategy for investors to hold it on for the next 3 years. Uh, Within that, if you dissect it further, there is this very interesting category called target maturity funds. Now, these come, these are of various tenors. You like 3 years, you go into 2025. You like 5 years, you go into 2027. Now, these are open ended indexed funds or ETFs. They allow you to lock in, because they are open ended funds, but of course, if you hold it to maturity of these funds, you end up realizing the yields which are the current market levels. So, a reasonable maybe 30-40% of your portfolios of fixed income can go towards that. The other two categories, where the remainder could be deployed, could be a combination of dynamic bond funds and floating rate funds. Why floating rate funds? Because every time interest rates are going up, the coupon rate, the interest rate that is being earned on these floating rate bonds are going up. So it's a great strategy to own. And dynamic, as the name says it all, it allows you to oscillate your views based on your views, increase or decrease duration on the portfolio. So if you have, of course, these are just a broad contour. Your advisor is a better person to guide you based on your risk appetite. But I think these are some of the categories which potentially could do well in the current interest rate scenario.
Thank you so much, Lakshmi, for a lovely conversation, and always a pleasure speaking with you.
Thank you. Bye.